Right, so we are continuing with International Accounting Standard number 12, income taxes. Right, so we want to conclude that by looking at what we call unused taxes. Right, so that's what we want to look at. We want to look at unused taxes, or what we call unused tax losses. Right, I hope my network will hold just fine. I think we still have a problem a bit with our infrastructure here. Remember, we didn't have electricity a couple of days before, and our internet was down. It's up now, but it's a bit slow. Hopefully, it holds on just fine. Right, so I want to look at unused, right, tax losses. Right, so, right, just like in financial accounting, where sometimes an entity can incur a loss instead of a profit, right, it is also possible for tax purposes that instead of having a taxable income, we end up with having a tax loss. So this happens, so this occurs, right, when taxable income, right, say taxable income, right, is less than deductions. Right, so this occurs when the taxable income is less than the deductions. So in other words, we then incur, right, this is a tax loss. Right, so it's similar to what we have in accounting. Remember, we say income minus expenses. Either we get a profit or we get a loss. For tax purposes, when we say taxable income, less deductions, the outcome can either be taxable income or it can be a tax loss. So when you say unused tax losses, or when you say tax losses, we are talking about a loss in the sense similar to what to accounting. Right, so that is what we are talking about. Right, so usually an entity is allowed, right? An entity is allowed to carry forward, right, any unused tax losses, right, and utilize these in the future, right, to reduce current tax, right, of future periods. Right, so normally, you know, when you have a taxable income or a tax profit, right, you must pay current tax over to SARS. Right, if an entity makes a tax loss, equally would have expected that SARS would have paid the difference over to the company. Right, however, SARS, their policies do not allow that they pay an entity for any negative taxable income, right, which is the tax loss. So what they do allow is that the entity, if it then incurs a tax loss, they can carry it forward to the future periods. And then in the future periods, when they now have positive taxable profit, your taxable income, they can reduce that taxable profit in the future by the previous tax losses recorded in prior years, so that they reduce the amount of tax that they pay in the future. But it's not going to happen that SARS pays you income tax for income tax losses. It doesn't happen. They don't allow it as a policy.
Yeah.
Right, people, are we understanding this? Right, are we on the same page?
Yes.
Yes, we understand.
All right, so that's a tax loss there. So what happens now, we need to do a question. The question is going to be similar to the work that we have done before, right? Slightly lighter than the work that we have done with a few transactions, but incorporating a tax loss. Right, so for this particular question that I'm going to do, I'm going to take it, it's from the tutorial letter, FAC4861, right, on page number 74. Right, I will share the question after the class. In the meantime, we can follow on the board. So this is the question, right? It deals with unused tax losses and it gives you different case studies. Right, so this is what they've said in the question here. Right, it says, prepare the income tax expense note and the deferred tax note of Super Limited, right, for the year ended 31 December of the year 2012 for the following scenarios. Then we have scenario number 1. Right, let's start by going through the question. It says the accounting profit before tax of Super Limited for the year ended 31 December 2012 is 450,000 Rand. Included in the accounting profit before tax are dividends received of 10,000 that are not taxable and a penalty of 50,000 that is not tax deductible for tax purposes. Right, let's meet good people as we are coming in. Thank you.
Already doing questions in Jan.
Sorry, come again. Right, let's continue. So yeah, just mute if you have a question, unmute, make a contribution, and then mute again. Right, on 31 December of the year 2011, prepaid expenses amounted to 60,000 and the unused tax losses amounted to 550,000. Prepaid expenses were tax deductible in the year 2012, year in accordance with Section 23H of the Income Tax Act. The South African Revenue Services assessment also reflects an assessment or an asset tax loss of 550 for the 2011 financial year. Now, Super Limited acquired a new machine on 1 January of the year 2012 for 300,000, right, which is depreciated over 4 years on the straight line basis. The residual value is nil. The depreciation has been included, right, in the accounting profit before tax. The SARS grants a 12C allowance of 40% in the first year, 20% the year per year for the subsequent 3 years, which is not apportioned for a part of the year. There are no temporary differences other than those apparent from the information provided. So I want to concentrate for this question on the income tax note. Right, so the company here, the name of the company, that's Super Limited. So we want to create an income tax note. So we're going to have Super Limited, right, as usual, notes, right, for the year ended. Right, our current year is ending on 31 December of the year 2012, according to the question. Right, 31 December of the year 2012, that's our current year. Right, so then we have our note. So the first note that we want to start with here is the income tax note. So we're going to say note number 2. So we say income tax expense note. Right, remember note number 1 is usually preserved from the accounting for the accounting policy note, right, which you have never asked for. So any note that you do can be number 2, number 3, whatsoever, but it can't be note number 1. Right, in terms of the income tax note, good people, where do we start? What should I write next? Right, are we there? Right, remember major components. So this is how you start major components. Right, and then there are 2 major components that you are going to highlight, which is, there are 3 actually. There is the current tax, and there is the deferred tax, and then there is the foreign tax. Right, so we start with current tax. Right, in this question, we won't have too many things on current tax, then we go to deferred tax. Right, so those are the 2 main components that we are going to have here. Right, you must be aware that if you made a tax loss, remember current tax represents the amount of tax that you must pay for a particular period as demanded by the taxation principles. So you can only pay tax if you made a tax profit for a particular year. Right? If you made a tax loss, you cannot pay tax, so there won't be any current tax for that particular period. Right? However, we are saying the tax loss now you can carry it forward and utilize it in future periods to reduce the tax that you incur in those periods. So therefore, if you have got a tax loss in a particular year, you won't have any current tax. Right? Are we very clear on that, good people? Are we understanding it? Right, good people?
Yes, David.
Yes, as long as you have got a tax loss, you won't have any current tax. So in this example that we are doing, we have got a tax loss. Right, then let's go to calculations. Now, if you are going to disclose the income tax notes, there are certain calculations that you have to do. Right, you have to calculate the current tax, even though you know you're going to have a zero, but you must know the magnitude of the current loss that you have. So you have to calculate the current tax. After that, you must also calculate your deferred tax for a particular period. So we're going to start here with calculation number 1, which is our current tax. Right, for the new guys who just came in now, who have not attended the class before, right, please remind me after the class. I will share the past sections so that you can catch up on those. Then we'll see what we'll do going forward from there, but I'll give you the previous 2 sessions that we have done for this module. Right, in terms of current tax, good people, where do I start? I want to see if you have been revising. Right, current tax calculation, where do I start? Right, no one has been revising. As usual, we start with profit before tax amount. Right, and then from there, we then bring in what we call non-taxable, right, or deductible items. Right, you can also just say exempt items here. Again, you'll be correct. Right, in this example that we have, we only have 2, so I'll leave space for 2 items there. Right, as usual, we want to add these 2 and get a total. Right, which we are going to highlight here. Let's see. Right, we're going to have a total there. Right, after that, then you will calculate a total here. Right, and then after that total, you need to bring in the movement in temporary differences. Right, by the way, this is how you do a question in the exam. Right, so that you are faster, you put your structures down like I have done. Right, you know what question number A is going to be. Current tax, you write down the structure. Right, you know that you are going to calculate number 2, deferred taxation. Right, you also put down the structure for deferred tax. Right, remember our current year is 2012. Right, when we calculate deferred tax, we are looking for the movement, right, from the prior year to the current year. So you need to have the prior year, and then you need to have also the current year. Right, so we're going to have our structure. Right, remember this question is more or less trying to present to you unused tax losses. So the information is not as extensive as you would normally expect in an exam type of question. Right, as usual, we then have carrying amount, we then have the TP, we then have the temporary differences. Right, we have the deferred tax. Right, asset or liability, this one was only at 28%, there was no change in rate. Right, so once we have that, right, then we can also present the current year, which is 2012. So you need to have both years. right? Remember, sometimes they give you the prior year. The last question that we did, there was that kind of scenario, right? You don't have to really compile the prior year because everything is there in the question itself. Right, you forgive me, my network is a bit slow, it's not as fast as usual. So sometimes my writing here is lagging behind a little bit. Okay. So now I can't cancel there. Anyway, 2012. Right, let me check the group chat. Right, I forgot to upload it on my phone here. It will take a bit of time. If anyone has got tutorial later, 4861, the soft copy, just share it on the group, please, for me. Thank you. Right, so we then have 2012. Right, and then we'll calculate the movement. So let's go to the question. Let's see what the question is saying. Right, so this is the information we want to do the note for income tax purposes. Right, and as usual, we always start by looking at the profit before tax. Right, it says here the accounting profit before tax of Super Limited for the year ended 31 December, 450 Rand. So we then have our 450,000 Rand here. Right, next we want to look at the exempt differences, just to check if we still remember our exempt differences. Good people, what can you give me? What examples can you give me here?
Dividends.
Right, we have dividend income. What else?
Fines.
Right, we have fines. Right, and penalties. What else?
Interest received. Interest.
Right, interest. Right, interest fee. This is not received. This is interest charged. Right, usually for late payment of taxes, not any other tax in here.
Okay.
Right, late payment of taxes. Right, donations. Right, legal fees. Right, what you want.
20%.
Right, what you want from this portion not tax deductible. So they will tell you in a question. Right, they may say maybe 20% is not tax deductible or 60% is not tax deductible. So what you want to account for here under the exempt differences, it is the portion that is not tax deductible. Right, can we be clear on that? Right, that only applies now to the donation and legal fees. It doesn't apply to all these other things here. Right, and then what else do we have, good people?
20% of
Right,
capital
20%
gain.
of any capital gain. Right, so again, this will attract or be included as part of the exempt differences. All right, someone has shared here. I don't know if I can, but we need it shared on the WhatsApp groups, ne? All right, I don't know, I can't pick it up from here. Right, but we can follow the class and go through this later. Right, depreciation on assets, right, without tax allowances. Now, normally this happens on what? On admin or factory buildings. Right, on admin or factory buildings. Right, so these are the items normally that we deal with. Right, we forgot foreign income, isn't it? Right, we also forgot foreign income. Now, these are items usually that we deal with under the exempt differences. Right, remember those differences are already included in our profit before tax amount here, but we are saying they are not recognized for tax purposes. Excuse me. Right, excuse me. Right, they are not recognized for tax purposes in determining the taxable income. So what we need to do, we need to remove them from the profit before tax. Right, so if we go through the question, we were given two items here. They said included in the accounting profit before tax are dividends received of 10,000 that are not taxable, and a penalty of 15,000 that is not deductible for tax purposes. So we've been given two items that we have listed: the dividend income, right, which amounts to 10,000, right, and 15,000 in penalties, which we're clearly told are not taxable. Now, what we do, remember, we are trying to remove these amounts from the 450 because they are not taxable. They are not recognized for tax purposes. Now you have got to do the opposite of what you did when you were calculating this amount. Right, dividend income being income was added to arrive at 450. If you want to reverse it, you must deduct. And then the penalty would have been deducted as an expense in arriving at 450. If you want to reverse it, you need to add it back. So income, you deduct; expenses, you now add. Overall, we're going to have a positive amount of 5,000, which gives us 455,000. So remember, this question wants to deal with unused tax losses. So you will see that most of the items here were not included, just one or two. But please make sure that you remember these items that also should be accounted for here if you happen to have them. Right, once we have that particular amount, we then need the amount movement in temporary differences. But the question is, where do I get the movement in temporary differences, good people? Right, where do I get that, good people? Right, the movement in temporary differences, right, you need to calculate that via the deferred tax calculation statement of financial position method. Now remember, when you calculate deferred tax, you have got to go to the statement of financial position, identify assets, identify liabilities. So usually where there is a difference between the carrying amount and the tax base of assets and liabilities, that's where deferred tax occurs. But only if the differences are caused by what? By temporary differences. So when we go to the question, right, they say on 31 December of the year 2011, prepaid expenses amounted to 60,000 and unused tax losses amounted to 550,000. Right, prepaid tax expenses were deductible in 2011 in accordance with Section 23 of the Income Tax Act. The South African Revenue Services SARS assessment also reflected an asset loss of 550,000 for the 2011 financial year. Right, so this is the information for the year 2011 that we have, and we can see that we had one asset, which is prepaid expense. So therefore, we need to account for that prepaid expense here, right? And the prepaid expense amount, right, was given here as an amount of how much? So that was 60,000. So we then have an amount of 60,000. This is the carrying amount of my prepaid expenditure. Right, good people, what will be the value of the tax base in this instance? What do we say?
The tax base is going to be 0 because SARS allowed us a deduction in the year 2011.
Right, wonderful. So SARS, according to Section 23H, already allowed a deduction in the current year. So therefore, they don't have a balance. Right, for accounting purposes, a prepayment, what we normally do, we then say we are applying the accruals concept. In applying the accruals concept, a prepaid expense does not belong to the current year. It's going to be accounted for in the next year. So we don't expense it in the current year, but we create a balance, which is the prepaid expense and asset account. But SARS says you can deduct this amount in the current year. So therefore, since they allow a deduction, they won't have a balance of that amount. So they will have a 0 there. And we have a temporary difference of 60,000. Right, remember our rate is 28%, so we multiply the temporary difference by 28, we are going to get 16,800, and it's going to be a deferred tax liability. Remember the rules. If it's an asset, carrying amount is bigger than the tax base, the result is a deferred tax liability. Right? If that is tricky, you just look at the 60,000 here. Is it a positive amount? Is it a negative amount mathematically? Right? If it is positive, then here is going to be a negative, which we show by brackets, representing a deferred tax liability. If mathematically we would have gotten a figure that is negative represented here in brackets, automatically the deferred tax would have been a positive figure, a deferred tax asset. Right, once we are here, good people, this is the only asset that they gave us in this particular example. If you had other assets, you will line them up and then calculate a total. So here now we then do calculate a total. Right, let me put it in black. Right, and then double line to indicate that I'm calculating a total. I'll just jump a line. Right, so therefore we have 60,000 here, which is our total. Now here is the trick. Now remember, an unused tax loss, which means that for tax purposes, you don't have a positive taxable income, but you have a tax loss. Right, SARS does not allow you to be paid in the current year. Right, under normal circumstances, if you make a taxable income which is positive, you have to pay SARS. That's why we create a provision that goes to the statement of financial position, because we'll be owing SARS. Right, in the same vein, if you then have a tax loss, you would have expected that SARS would have paid you, but SARS does not allow a payment in that way. They allow you to carry forward a negative amount or a negative taxable profit. And then in the future, when you have positive amounts, you can deduct that from there, thereby reducing your tax in the future. But in the same way, that when we are owing SARS, we recognize an owing to them, a provision that goes to the statement of profit and loss under current tax that says SARS. Right? If it so happens in this instance that we've got an assessed loss, right, SARS is owing us, then we are saying SARS is owing us, or SARS is simply saying they are owing us. Now, that amount that SARS is owing us is only recognized by taxation. It's only in the books of what? Of SARS. So therefore, you have to bring in an assessed, right, tax loss here. Right, remember, we are taking it from the books of SARS. That's when they have this. The amount we were told in the question is 550,000. This is the unused tax loss, right, at the end of what? 2011. So we then have an amount of 550,000 here. Right, so let me explain this again. Right, if you have got a positive amount, which is taxable income, we will calculate the amount that you are supposed to pay to SARS. Right, and it will be accounted for as an owing to SARS. Right, if you have got a tax loss, right, according to SARS, they are saying they should have paid you for the negative amount that you got. However, they don't allow a payment in cash. You use that loss to reduce your tax profits in the future. So to SARS, they are saying they are owing you. And this amount owing of 550, which is the total value of the tax losses cumulative up to 2011, right? SARS is saying they are owing you that. So therefore, they have a tax base for it, which is 550. It's a positive amount because to SARS, that's an asset. They are owing you that. Right? Are we clear on that, good people? Any question? Right? Are we on the same page?
Yes.
Right. So what we then do, we then check now what SARS is saying. Right. You go to the question. If you go to scenario number 1, this is what they said. Right. The future taxable profits are probably both in the financial year ending 2011 and 2012 as the budget for 2013 reflects new contracts that will increase taxable profits in the future to 1 million. Right, so you have to look at section 12.82. Right, International Accounting Standard number what? 12. Please go and read this part, 12.82. Right, you go and do a bit of research there. Right, just to get the wording, but I will explain what the standard is saying. Right, so SARS is saying an assessed loss can be recognized as an asset, right, only to the extent that future taxable profits will be available in the future, under which that particular loss will then be deducted under. Right, so you see in this example, we have said the taxable loss is an amount of 550,000. But they are telling you that you are confident, and you were confident of this from 2011 and both 2012, that you will be able to recover this amount in the future from taxable profits. Right? Because you are confident that in 2013 you will start making profits of what? 1 million. In which case, this particular amount, which is the assessed loss, can then be deducted from there. Right? If you don't have potential to generate a positive amount in the future, then the amount will not be recognizable in full. But as long, according to section 12.8.2, if you are confident as an entity, maybe through some written contracts, some written tenders that you have already signed, which guarantee you in the future that you'll be profitable, then you will recognize this amount because it is recoverable. An asset can only be recoverable if it is recoverable by an entity. You can't have something that you call an asset which is not going to be recoverable, which is not going to generate income for you. So that's the principle. So once you see that we are saying in 2011, we are going to have enough profits in the future to cover that amount, what you do, you then recognize the full amount here. So therefore, you are going to have 550,000 there. Now it's 0 minus 550. The answer is a negative amount. Right, then you say that negative 550,000 times 28%, you are going to have 154,000. Right, then you close the calculation, right, for the prior year. So 60,000 plus 550,000 negative, then you are going to have 490,000 here. Right, multiplied by 0.28, you are going to have 137,200. Right, remember here it's going to be negative. Here automatically it's going to be a positive amount. So this is your calculation in the year 2011. Any question? Right, you are very quiet people. Any question? Right, are we all on the same page? Are we understanding this? Right, so I have to be clear, if you are in CTA, both 1 and 2, and you are doing FAC 3761, your question will definitely have unused text. You have to be very clear on this. If you are doing 3701, this is where now we separate the boys from the men. 3701, you may have a little bit of unused texts, but it's not as hectic as the guys in CTA. But you still have to know this because it can be asked, but at a slightly less challenging level. But everyone needs to understand unused text losses. Right, so hopefully we are on the same page. Right, let's go to the current year. Super Limited acquired a new machine or machinery on 1 January of the year 2012, which is the beginning of the current year, for 300,000, which is depreciated over 4 years on the straight line basis. The residual value was nil. The depreciation has been included in the accounting profit before tax. Right, SARS grants a Section 12C allowance of 40% in the first year and 20% per year for the subsequent 3 years. which is not apportioned for the year. All right, so now we have another asset, which is machinery. So the prepaid expense will have been paid already. It's no longer there at the end of the current year. Right, on our machinery, this machinery was bought for 300,000. Right, we want to deduct the depreciation for that year. So which is depreciated over 4 years. So the depreciation, just divide that by 4. Remember, the asset was bought at the beginning of the year. We have only depreciated it for one period, and therefore the depreciation amount is 75. So we then say 300,000, which is the original cost, minus the accumulated depreciation. That is going to give me 225,000. So this amount is what I'm going to account for here as the carrying amount of the asset. Right, then I go to the tax base. Right, the asset 300,000. Remember, they said in the first year they allow a deduction of 40% of the value. So therefore, multiplied by 40, that gives me 120,000, which is the tax allowance allowed. Then we are saying from that tax allowance, let's deduct the 120,000. From the cost price, let's deduct the tax allowance of 120. We are going to be left with 180,000, and that represents the tax base. Right, good people, are we following? Are we on the same page?
Yes.
Right, so we are going to have a difference of 45,000 positive times 0.28. We are going to have an amount of 12,600. Right, that will be negative because mathematically that's positive. So this is the only asset that we're given in this particular example. So we need to close our calculation. Right, remember in another example, you may have 1, 2, 3, 4 assets. It means you have to line them up and then calculate a total. Right, so then I have my 45,000 here. Right, how come I can't write? Right, thank you. 45,000 here. Right, and 12,600. Right, then we need to bring in unused tax losses. Now here is the trick, good people. When you calculate your current tax, remember you need this value, which is the movement in temporary difference. Now that particular value, you have to get it after you have calculated your what? Your deferred tax prior year, deferred tax in the current year, and then you calculate your movement. Right, so we say movement, right, in temporary differences. Right, movement in temporary differences. Right, once we have that, now remember, we have unused tax losses here, which we were not having in the previous question. So what you do, you say excluding. As long as you have unused tax losses, you say excluding unused tax losses. So the calculation is going to be done in 2 stages. Right, excluding unused tax losses. Right, then you say, what was your temporary difference? Right, it was 45,000. Right, it was an amount of 45,000. That is before the what? The unused tax losses. And the figure was a positive amount. So you say 45,000. Right, you go to the prior year. Right, you want the figure before unused tax losses, which is that value, 60,000. So therefore, you now subtract the 60,000 here. Right, what you are going to get, it's a 45,000 minus 60,000. That gives you a negative amount of 15,000. Right, that 15,000 multiplied by 28, the rate of deferred tax, that gives you 4.2, which is a deferred tax asset. So that's your movement in temporary differences for the current year, there was a decline of 15,000. So that 15,000 means these are deductible temporary differences, which means in the future they will reduce taxable income by 15,000, but in the current year they will increase it by 15,000. So therefore, you are going to have 15,000 here. Right. Are we on the same page, good people? Anyone who needs an explanation somewhere?
Yes, yes, sir.
Yes, ma'am.
Um, please, can you explain again on that when we get the 4.2? So the 4.2 is not it's just a deferred tax. It's not that one we put on movement in temporary differences.
Yes, remember now, as you see here, this one coincides with temporal difference. This one coincides with what? Deferred tax. So this is movement in temporal difference. This is movement in deferred tax. Right. So you can calculate that movement in deferred tax by comparing this amount, you see. That's your deferred tax in the current year minus the deferred tax in the prior year. It will give you that 4.2.
Oh, okay, thank you.
But you know what we want to take here now is the movement in temporary differences. That's the one that we bring in. Right. Remember, if it is positive here, then it is a negative here. But this time it was a negative here. When you take it to this side, it becomes a positive. Right. It's a what we call an increase in deductible temporary difference. When we say deductible temporary differences, we are always saying that with reference to the future. If it is a deduction in the future, then in the current year, it increases the temporary difference. So it will always be inverted like that. Right. Make sure you remember that. Ne?
Okay, thank you.
Right. Once we have that 450, we then say at the end of the year, 2011, right? Remember, we are in 2012. We then say unused tax losses, right? Prior year, right? The unused loss, yes, it has been agreed between us and SARS that 550 is unused tax loss or is a tax loss in 2011. Right, which means we carry forward that amount to the year 2012. So this is the amount when we open the year, we'll be having a negative amount of 550. Right, so therefore it's still relevant in the year 2012. We come and deduct that amount. Right, remember when you have a tax loss, when you go to the future period, you are allowed to deduct the tax loss from the taxable income of that particular year. So in this instance, we can see our positive taxable income before the tax loss is 470. But we have a tax loss of what? 550. Right. So when we deduct, it means we are still having a negative amount of 80,000 remaining. So this is cumulative, right? Unused tax loss. Right. Please go ahead, Molohadi.
Okay, sorry, David. Aren't we going to include that depreciation? Remember, we had depreciation somewhere. I don't know.
Right. The depreciation, we are not going to account for it here in the calculation of current tax. Right.
Okay.
Because it is a temporary difference. And the temporary differences, we don't show them one by one. Right. Temporary differences via the statement of financial position. So we have already dealt with it.
Okay.
So in your current tax calculation, right, you deal only individually with the exempt differences. Okay? Anything that is
Okay.
difference, if it's a temporary difference, it's accounted for via this total. Right? Do you understand?
Okay. Yeah, I get it now. Thank you.
Sure. Right. Then we end up with a negative amount of 80. What does it tell you? Out of the 550,000 amount, right? We have utilized our positive amount of 470,000 to clear that down to what? 80,000. So that at the end of the current year, we have a balance of 80,000. Then we can conclude now the 20 what? 12th year. Now we can see the figure has been reduced to what? 80,000 here. Right, 0 minus 80,000 is going to give you 80,000 negative. Right, that 80,000 negative times 0.28, that is going to give you 2,400. Right, which is a positive amount. Then you can conclude this calculation. Right, are we following, good people? Right, so that gives me 35,000, which is negative, times 0.28, which is 9.8 positive. So this is how we account for this amount. You cannot account for this amount until you have calculated up to the end of the current tax calculation, because you want to know what the negative amount is that you are having. Right, we had 550 opening balance. We now had positive amount of 470. Right, we then use that 470 to clear the 550. Now we are left with what? That amount. So whenever you have this, you don't have current tax. Right, current tax is nil. Current tax determines the amount of tax that you must pay. We don't have to pay tax. We have a what? A loss. Right, once we have this, then we can conclude the movement. You can't conclude that movement until you have got this line. Right, because now you want movement in unused tax losses. Then you say, what are your tax losses? Balance, the tax losses balance is 80,000 at the end of the year. It's a negative amount, so I'll say 80,000 in brackets. Right, minus, I go to the prior year. Right, what was my balance of unused tax losses in the prior year? 550 negative. Right, 80,000 negative minus 550,000 negative. I am going to get 450,000. Right, which I bring here. That's 470,000. Right, times 0.28, I'm going to get 131,600. Now remember, this is positive, this is going to be negative. Then we close our calculations in this way. We calculate, remember now we are calculating the movement in temporal differences, but in two stages. I need to get a total. 15,000 negative plus 470,000, that is going to give me 455,000 positive times 0.28, that is going to give me 127,400, right, which happens to be a negative amount. Right, with that, I am done with my calculations. Any questions from the floor? Right, are we clear? Are we understanding everything, good people? Right, when it comes to unused temporary differences, this scenario is the easiest, where the question tells you that both the prior year and the current year, you are guaranteed future taxable what? Profits. So I want you to be very clear on this one, because the next one will be slightly complicated than this one. If you have a question, please ask. Right, then we go to the income tax expense note. Right, remember we use this to determine the amount of the income tax expense for the year. Right, the income tax expense, you add your current tax, you add your deferred tax, and you add your foreign tax expenditure. Right, you add those three together to determine the income tax. Now, current tax, we say it is 0. Then we go to deferred tax. We then say movement in temporary differences. right? For the movement in temporary difference, you want this value now. This time now, when we go to the expense, we are looking at the movement in deferred tax. So you take this value here. So that's your movement in deferred tax, right? Based on what? On temporary difference, excluding unused tax losses. This is what we call movement in temporary differences. And the value is 4.2. Now remember, if it is a negative here, when you take it, it becomes positive. This one was a positive amount. So when you take it now to the other stage, then it will become a negative amount. Right? If you want to understand this, right? Remember, we are saying we moved from a deferred tax expense of 16.8, which was a deferred tax liability. Right? And then it reduced to 12.6. So there's been a decline in a liability. Now, what reduces a liability is income. So therefore, we are saying the movement in deferred tax here induced a what? A taxable income, sorry, an income tax positive, which means it was what? A tax gain. What are we trying to calculate here? We're trying to calculate a tax expense, but we got tax income. It reduces the tax expense. That's why that figure is in negative. Now, that one students usually don't understand. Any question? Right? If you don't understand it, don't worry. I will keep on hammering the point until you understand it. But in the meantime, remember, when you transfer this amount, if it is positive here, when you transfer it to the top, it must become negative. Now I'm teaching you to cram. Then you still get the answer. But at the end of the day, you must end up understanding why you do that. Right? There was a decline in a deferred tax liability, which means income tax there was a recovery of income tax. It's an asset, it's income to the entity. I'm trying to calculate expense here. So income will go in as a bracket to reduce the tax expense. Right? Any questions, good people? Are we following? Are we on the same page?
Yes, we are processing the information.
Sharp. Right, sharp. Hope you will get it right. If you don't get it right,
Yes,
call me. Right.
sure.
We have the other movement now. Right. So we then have this movement. Now remember, we had a balance of 550,000. But it is reduced now to what? 8,000, giving us a movement of 470,000. So we are saying that this is what we have utilized of the unused tax losses. So we then say here, right, unused tax loss right, utilized. Right, then we just get that figure there. Right, we now want the portion that affects deferred tax, which is 131,600. You can see it's a negative there. It becomes a positive. Right, then you'll be done with your movement in deferred tax. Now, this thing is very simple, good people. It's speaking about the accruals concept. We are trying to calculate the expense of taxation for the current year. Now, if you remember the work that I taught you last time, right, this, when you take the profit for the year, then you remove the, what you call it, the exempt difference. The amount that remains, ungayishaya ngo-28, it gives you a tax expense. But we did not put any current tax here, simple because of the previous year's tax, but it doesn't change the fact that our current tax is 470,000 times 0.28, which is 131,600. Right, are you following? Right, if you say 470,000 multiplied by 0.28, it would have given you 131,600. So that amount would have represented your current tax for the year, had it not been for the 550. Are we clear about that? Good.
Yes.
So what it means is that we don't have anything on the current tax year, right, because of the figure that was fostered on us by SARS who refused to pay us. But it doesn't change the fact that the current tax expense for the current year is the 131,600. That is the current tax for the year. So based on the accruals concept, it means that current tax should be accounted for tax purposes in the current year. Now, the reduction to zero here is owing to an adjustment for prepayments, right? Which prepayments, or which this amount, so not prepayment, this 550,000, which is the unused tax from the prior year, would have been accounted for accounting purposes in the prior year. It mustn't affect our accruals concept in the current year. Right? If you look at this, if it wasn't for that 550, I would have been having 131,600 here. I would not be having that. Are we clear about that from the previous week? To determine my tax expenditure for the year. Now, because I have this tax loss, which is basically just an accounting adjustment to take into account the calculations for SARS, we did not put anything there, but to make sure that we get to the correct amount of taxation, we brought that amount down here. So we say 131,600 minus 4,200, we are going to get an amount of 127,400. Right, while you are still processing the information that I'm giving you, the explanations, just remember, if you can get to this calculation, you don't have a problem at all. Right, if you can do the movement in temporary difference, you just look for this figure. Right, if it is negative, when you come to the top there, it becomes a positive amount. Right, then overall, we now get 127,400. This is SA normal tax. Right, if we happen to be having foreign tax, we don't have it in this question. It would have come there, but we don't have foreign tax there. Right, so our tax expense for the current year is 127,400. That is the amount that we would have been looking for. And if we're supposed to present the statement of P&L, I was going to say profit before tax minus income tax 127,400. That's where this figure was what? Going to go. Right, please go ahead, Lee.
So I just want to ask, isn't foreign tax exempt? Why would we calculate it there?
Right. This issue of exemption, we are saying if you earn income from a foreign country, in South Africa, you are not going to be charged tax if there is a double tax agreement between South Africa and the foreign country. Ne? Right. The reason for that is because you would have paid tax in the foreign country. So we don't want to charge you tax again in South Africa. So what happens now is that usually when you get your profit before tax here, this profit before tax will be including the foreign income, which means usually when you get this amount, it will include also the foreign income. When you calculate this current tax here, that current tax will already contain, will be containing tax on the foreign income at a rate agreeable in South Africa, which is 27 or 28%. Right, are we clear about that? Right, if you don't treat the foreign income as exempt, which means you remove it from here, it will go all the way up to the current tax calculation. So that when you calculate your tax here at the end of your current tax calculation, you will also be calculating a portion of tax on the foreign income. And that will mean double tax because you pay that, yet you have already paid in the foreign country. So to avoid that, we then say foreign income is an exempt difference. Then you remove it here so that this amount does not carry any foreign income. When you calculate by 27 or 28% here, this will not carry tax on the foreign income. Are we clear?
Yes, sir.
Right, but it doesn't change the fact that in the foreign country you paid what? Tax. So when you do your calculations here, it is not including foreign what? Tax. When you do your calculations here, it doesn't include foreign tax right up to this point. And then what you do, you then say, what is the tax that we paid in the foreign country? Then you add it here. That way you avoid what? Duplication. Right.
Yes, sir.
If foreign income is exempt, it means it mustn't be taxed again in South Africa. But when now you are sitting down as a company to say, what is my tax expenditure for the year? It is plus the foreign what? Tax that you paid in the country where the income was sourced. Right, hope it makes sense. Right, so we then have that amount, and then usually you will then need to do a reconciliation. Right, what we call a tax rate reconciliation to complete your note. Right, I'll just continue with the presentation that I gave you to say standard tax. Right, but we can always present it differently at CTA, mostly just a slight tweak. Even if you write it like this, you get your max in full. 450,000 times 0.28, which is the 126,000. Now we are saying when you go to the statement of profit and loss, you take the profit before tax amount, you multiply it by 28. This is the amount of tax that you should have been sitting on if you had multiplied the profit before tax by 28. Right. However, you don't have that amount because when in your income tax expenditure, you're going to include that amount. We want to understand where the differences are coming from. And what do I do, good people, to reconcile? What should I look out for? Right. Remember, in my calculation of current tax, I took this amount, profit before tax. I removed the exempt differences, but I have not done the same here. So the exempt differences are my first reconciling items. So therefore, I'll bring the dividend. Right, income, I'll bring the penalty here. This one, 10,000. This one was 15,000. I simply multiply these by 28%. This is going to give me 2.8. 15,000 by 0.28, that is going to give me 4.2. Right, remember, income, you deduct, expenses, you add. We are done with the reconciliation. 126,000 minus 2.8 plus 4200, we are going to end with 127,400. So that will be the end of my disclosure up to tax rate reconciliation. Any questions, good people, across the whole question? Right, you must get the same amount here as in that point there. Then everything will be 100%. Right, are we on the same page, good people?
Yes, sir.
Right, this one was scenario number 1. Right, let's look at part 2 of this. So we go to scenario number 2. Right, so there's a slight change in the information, but we're calculating the same. Right, so I'm going to calculate my notes again. So this is super limited. Right, then in my notes, I'll have my notes, right, for the year ended 31 December of the year 2012. Right, then we can have major components. Okay, sorry. Income tax note, note number 2. Right, income tax expense note. Right, then we have major components. Right, we have our current tax. All our expenses don't have current tax. We have a tax loss. Right, then we'll deal with deferred tax. Right, so now we need our calculations. We need the current tax. Now the current tax is not going to change because remember we're using the same information, but there is a change in how we deal with the taxable temporary difference. So there is not going to be a change here. Right, on the current tax calculation, we are still going to have the same. All right, so I'll just copy that. Right, the question is the same. That's why we're having the same current tax calculation. Right, just for interest sake, right. Right, so we are still going to have the 450,000. Right, we are still going to have everything the same here up to the end. Right, so I'll be referencing back to the calculation and showing you that the figures are the same as we calculate and do the other stages. Right, I'm just removing the yellow markings. Right, unused text, it was 550,000. Right, so we're sitting on that. Now let's go to the deferred tax calculation. Right, the deferred tax calculation will like
Thank you.
right, so we still need the prior year. So we're still looking at the year 2011 here. Right, I don't think there's going to be a change. Let's see what we have from the information provided. So, but we have the carrying amount, we have the tax base, right, temporary difference, and the deferred tax assets or liability at 28%. Right, so we still have exactly the same information where we had a prepaid expense of 60,000. So nothing changes there. Right, so but we will have to see if there is a different information concerning the what? The deferred tax. So it was still the same, 60,000 prepaid expenditure. Which gave us 16,800 negative. Right, and then remember, if there was a total, I will look for the total here in unused tax losses. So if I wanted, I could have left it like that because this is already a total. Right, then we bring in unused tax losses. But to answer this, we've got to listen to the question. What does scenario number 2 say? Right, assume that future taxable profits were probably in 2011 but when re-evaluated at the end of 31 December 2012, they are not. Right, so in 2011, when we did our evaluation, we said we are confident that we'll have future taxable profit against which to deduct the unused loss. If that is the case, then we don't limit the unused tax losses of 550,000. We allow the unused tax losses in full. Right, so we say 550,000 by 0.28, and that gives us 154. So nothing has changed there. It's still the same as long as the question says you are confident that future taxable profits at that particular point were going to be earned in the future against which to deduct the negative amount. Right, so you're going to get 137,200, which is going to be positive. This year is negative. Then we go to deferred tax for the year 2012. Right, so 2012, there's going to be a slight change here. Right, carrying amount, tax base, temporary difference, deferred tax, asset or liability at 28%. Right, so once we have this, remember, nothing changed concerning the machinery, still the same example, just a small trick. So we still have 225 here. We still have 180,000 here. Right, so 225,000 minus 180, that gave us what, 45. 45,000 times 0.28, that gave us 12,600, which is a deferred tax liability. Right, so with that, you will then have calculated your movement, right, in temporary differences, right, excluding unused tax losses. Right, so if you then go to the question, unused tax losses before, or unused temporary difference before tax losses, still 45. Unused tax losses before, or sorry, temporary differences before tax losses, 60,000. Right, are we still together? No one is here anymore. Right, so that gives a negative amount. Right, so remember, we need to take this amount to the current tax calculation. So nothing has changed. We still have a positive 15,000, which is going to give us that from, or minus 550, we're still going to end with 80,000. So nothing on the current tax calculation. It's the same example. The only change is going to affect when we go to deferred tax in the current year and we deal with unused tax losses. Right, check section. Remember I said you must look at section 12.82, right, where you get the theory from the standard there, but I will explain it. Now, this is what they said, but when re-evaluated at 31 December, they are not. So remember, we're talking about future taxable profits were probably in 2011, but when they were re-evaluated in 2012, they are not. What is the implication of that? Now, when you have a tax loss, remember we now are remaining with a tax loss of 80,000 here. You can only recognize that as a temporary difference to the extent that you have got positive profit in the future against which to deduct that amount from. So in 2012, they are saying you don't have an expectation of improving your profitability, and therefore you're not guaranteed to cover that amount. Now, the only taxable income that you have is this 45,000. Remember, it's a positive amount. It's a taxable income in the future. So therefore, you have to limit that amount's recognition to only 45,000. Right? You can't recognize the full amount, and you end up with zeros everywhere. Are we clear about that point? Right? Any question there? Are we understanding it? You're very quiet, people.
Sorry, Mr. David. Will I be wrong to conclude that if the what is it? It's probable that we're gonna have taxable income
Yes,
in
future
future?
enough to cover the 8,000 there. Yes, that's what you want to say, eh?
Yeah, if we're gonna have if it's probable, then it means in the previous year we won't have what is it? We won't have deferred tax, and if it's not probable, then we won't have deferred tax in the current year. Will I be wrong to conclude that?
That will I think that will become right. What you must do, I want you to have a clear understanding of what to do with this amount. Eh?
Okay.
So, right, what you do, you go to the question and check what do they say about 2011. At the end of 2011, your projections for profit, were they telling you that you will be able to raise enough profits to cover that in the future? Eh? Right, this is what they say concerning 2011. Right, they said assume that future taxable profits were probably at 31 December 2011. Right, so since the profits were probably, what does it mean for your calculation? Right, for your calculation, what it means is you can go ahead and recognize full amount, which is what we did today. Can you see that? We said 0 and at 550, we recognize the full 550,000. Are we clear?
Yes, yeah. Thank you.
Yeah. Then if we go to 2012, this is what they say. Remember, now we are having this amount. We are saying, what do we do concerning this amount? Then you have got to check the question. Here they said, but when re-evaluated at 31 December 2012, they are not, which means they were not confident that they will raise enough profits to cover that amount. So if that is the case, then the recognition of that amount will be limited. We can't recognize the full 80,000. Right. However, a positive amount here means that you are guaranteed 45,000 taxable profits in the future. So this amount will only be limited to whatever you are having there. Right. You understand it? And you're done. Right. I hope we are clear, good people. Right. I need you to be clear because you would definitely have a question with income tax, with deferred tax calculation in your test. Everyone. Right? And it will usually come with unused tax losses, so you can't miss it. You have to be very clear. And the good thing, good people, if you know that something is going to come in the exam, you can't make a mistake. You have to make sure you get it right. It's very rare for you not to have a calculation of this nature in the test. It's rare. It can happen, but it's very rare. So this is one of the most popular topics. You need to be very clear and you give yourself a good chance to get a good score. Right, once we have that particular amount, then we go to movement in unused tax losses. Right, in which case you say 45,000 negative, that's your unused tax losses recognized. In the prior year, you would have recognized the full 550,000 in unused tax losses, which is a negative amount. All right, so if you say 45,000 negative amount minus 550,000 negative amount, right, you are going to get 505 here, which is a positive amount. Multiplied by 0.28, you are going to get 141,400, which is going to be a negative amount. Right, then you can now add your totals here. Right, so if we say 15,000 negative plus 505,000, you are going to have 490,000. Right, if you say 4200 minus 141,400, you are going to have 137,200, which is negative. Right, now we can do our disclosure here. Right, first, movement in temporary differences. $4.2, right, which is a negative amount. Remember, we take this amount. It is positive there. When we transfer it, negative. Next, we then move this amount here, which is unused tax losses utilized. 141, remember it's negative 141,400. When I bring it here, it's going to be a positive amount. All right, this is unused tax losses, right, utilized. All right, then we can add the two amounts there. Right, 4200 negative plus 141,400, that is going to give me 137,200 here. All right, so 137,200, I'll be done. Remember, I don't have foreign tax here. Right, once you have that, tax rate reconciliation. Any questions up to where we are? Ah, you're very quiet. I would imagine everyone is understanding, yeah? I want to imagine everyone is understanding. I hope so. Right, then we bring our standard tax. 450 was the profit before tax, right? Theoretically, we should have been sitting on a tax of how much? Right, 126,000, but we are sitting on 137. Where is the difference? Deferred tax or dividend income, sorry. Right, and the penalty contributed. These amounts were included in the profit before tax year, but we eliminated them in our calculations to get that value. So if we are to get the same amount, we need to eliminate them also from that figure. Right, that gives us 2800, 15,000 by 0.28. That gave us 4.2. This we deduct, this we add. But we are not finished. Right, you see, when you go to the current tax calculation, right, our current tax was an amount of 450,000. This is the amount that defines our current tax for the current period. The calculation of the unused tax loss, it now takes into account how we paid that particular, or how we are going to settle that particular what? Current tax. Now, when we recognize an expense, we use the accruals concept. Accruals concept says an expense should be recognized in the period in which it is incurred, not according to how it will be settled. So we are saying our current expense should be defined by that amount here. Right, so if we now go to this, or at the top here, right, what we are saying is that when we look at this amount, it is now going to give us the same tax as we were going to have if we were basing on current tax, because we have taken now the what? The profit for the year, and we have removed the exempt differences. So we should have been sitting on the same tax as this one, but we are not. What is the reason for that? Right, the reason for that is very simple. Now, remember, there was a limitation here. There was a limitation there. Right, 80,000 is what should have been recognized. But we recognize what? 45,000. So there is a difference there, right, of 35,000. So this is unused tax losses that we did not recognize for accounting purposes. Because for accounting purposes, look, we dealt with this amount, which is 470. If you say 470,000 multiplied by 28%, it's going to give you how much? Let's see. That is going to give you 131,600. But we did not deal with that because we ended up with a bigger figure, which amount we said is what? I think I'm overextending. You have nightmares. 141. Or we ended up with 137, 200. Okay, or 141, 400 minus 131, 600. Right. But we ended up with 141,600, which gives a difference of 9.8. We need to account for this because this extra amount is recognized here, but it was never recognized there. We did not account for that because there we accounted for the 47. So you come here, you say unused tax losses not recognized. You say 80,000 was the full amount, but we only recognized 45 multiplied by 28%. Right, you get 9.8. So we are saying the use of this amount, right, which gave us 141,400, it came from the fact that we limited this amount, which means it increased our temporary difference. That's why we're having that amount there, which did not happen in the second calculation here. To get the same amount, we need to add that amount there. You will balance. Right, but you must remember that if you limited the unused tax loss here, right, the difference between the two, which is the 35,000 here, it's a reconciling item, right? While you are processing the rest of the information, just remember, if there is a limitation here, when you now go to the reconciliation, you need to bring in the unused tax losses not recognized, which is that 80 minus 45 by 28. It's an addition there. Then you'll be able to balance. Right? If you hear students saying income tax is a nightmare, deferred tax is a problem, it will be on unused tax losses. That's where the big problem is. That's where the big challenge for students is. Remember, we haven't dealt with deferred tax through other comprehensive income. Now remember, here we have been dealing with deferred tax coming from items that are recognized in profit before tax. It can also come from items recognized in OCI, in which case now you would deal with movement in temporary difference, unused tax losses, and unused or movement in temporary differences through OCI. So now you will separate this. You will say movement in temporal differences through PNN. You have movement in temporal differences through OCI, and then you have unused tax losses as well. Then it becomes a little bit complicated. But if you take it nice and slow, it's a very, very simple calculation. Any questions from the floor? Right, are we there? Right, good people, can you still hear me?
Yes,
Yes,
sir.
yes.
All right, let's go to scenario number 3. Right, scenario number 3, we still have the same example. So which means we still have the same structure. So we still are looking for the nodes, right? And then major components, right? On major components, we have the current tax. Right, we have nothing, and then we have the deferred tax. We only have nothing there because we know from the previous calculation that the taxable income was a tax loss. Right, then we can go now to our calculations. Right, starting with current tax. Right, the current tax, let me copy it from the top, nothing changes. It's still the same question. Right, so the current tax will be the same. Right, where is this mouse? I can't see it. Right, my mouse has disappeared. Right, so current tax. Right, what we now are going to have is a difference in terms of deferred tax. But there is nothing new. Right, so we say 2011. Right, we still have the prepayment, so I'll just say carrying amount, temporary difference, or tax base, right? Temporary difference and deferred tax. Right, so we still have the prepaid here. Same question, same information. We still have 16,800. Right, then we have unused tax losses. Right, on unused tax losses, this is what is happening. Right, the future taxable profits were not probably on 31 December 2011. Right, we know that in 2011, right, we were having an unused tax loss, right, of 550,000. My question to you is, what must I do concerning that figure? Remember, I have 60,000 here. I have 16.8. Right, they told you that even in 2011, at this particular point, the profits were not guaranteed. So what must I do to the 550? Right, who can guess? I must limit. Yes, ma'am.
Well, I was about to say, aren't we going to limit it?
Yes, we have to limit. Thank you. We are going to limit it to 60,000 a year. Right, which means we are going to have 16.8. We are going to end up with what? With a 0 here and there. Right, are we clear? Right, then we go to 2012. Right, again, we have the carrying amount, we have the tax base, we have the temporary difference, we have the deferred tax. Right, so this time we've got the machinery. Right, we still have the same figure, 225,000. We still have 180,000. Previously, it gave me 45. It should be true. And I got 12 point, was it 12.8? Right, it was 12.6. Right, then I bring my unused tax losses. Right, I know from my previous calculation it's going to be 80,000. What did they say? But then they say are not probably as at 31 December. So they were not probably on 31 December 2011, but are probably at 31 December 2012. So in 31 December, we were now confident our projected profit is 1 million. So we're thinking we'll be able to cover that. What should I do this time to the 80,000? Should I limit or should I not limit? Right, as long as you're expectant of receiving enough profits, then you are not going to limit there. Are we clear, good people? Right, good people?
Sorry, where did we get the 80,000?
Right, the 80,000, you get it from the current tax calculation, this one. Right, remember you would have done your calculations and gotten up to this point. So you're saying, what is the outstanding amount at the end of 2011 that, or what is the tax loss balance, the cumulative tax loss now? So you do the current tax calculation until you get that figure there. And that figure is the one that you then bring here. This one, we don't have to calculate, it was given in the question. But the one for 2012, you always have to calculate that. Now, because they said you are expecting future profits to be adequate, you don't have to limit. You use the whole amount. Right, so that is going to give me 35,000 negative. Right, that gives me 9.8 positive. So this will be your calculation up to that point. Right, then you can say your movement in temporary differences. Right, excluding 45 minus 60, nothing changed there. You got 15,000. You are going to get 4.2. Right, then in unused tax losses, this time you've got 80,000 negative. In the prior period, you had limited to 60,000. So you've got 60,000 negative here. Right, so that when you calculate, you are going to get, is it going to be a positive amount? Right. Right, so that's going to be a negative amount of 20,000. Right. This one is negative. This one is negative. And that should give me 5.6, 20,000 by 0.28. That gives me 5600. Right, so that ultimately you then add your totals here. Right, so we are going to have 35,000 here, negative. We're going to have 9.8 positive. Right, when you now go to the other side, to the disclosure, movement in temporal difference is still the same question, nothing has changed. So we have our movement in temporary differences, which is an amount of 4.2, and we're going to be deducting that. Then next, we then have a recognition of unused tax losses. Right. All right, we say recognition of unused tax losses previously not recognized. Right, remember, we had 550 in the prior year, but we had only allowed 60,000. Right, so therefore, this is what we are talking about. Right, remember there had been a limitation there. Right, so I want to check something, 550,000 minus 60,000. Right, so that would have been the limitation that you did. So you need to account for that here. So that will give you 137,200, and that will be a deduction. Then you bring in unused tax losses recognized in the current year. So unused tax losses recognized in the current year. Right, you go to your current tax year. I hope you remember this. This is the balance that was outstanding. Right, we have reduced it by what? 470. So which means we have recognized those tax losses. So therefore, you're going to say 470,000 multiplied by 28%. Right, that is going to give you 131,600, and it's going to be a positive amount. Right, and then you are done calculating there. So 42 negative plus 137,200 plus 131,600, that, what am I getting there? 42 negative plus 137,200 negative plus 131,600, I get 9.8 negative. So in this instance, you're going to record 9.8. As instead of deducting it, you are going to actually add this amount under profit before tax. Right, this amount, when you look at it, it's equivalent to this value. So you could have simply taken this value, 5.60, and say unused tax losses, and then you just disclose 5.60. Again, you will have been correct. What we have been doing, you can take it from there, right? This is equivalent to 5.6, and it will have been a negative amount. You will still get it correct. Then you go to your reconciliation. Right, standard tax, 450,000 multiplied by 28, which gave us 126, how much? At 126,000 straight. Right, your exempt dividend, 10,000 multiplied by 28. Penalty, 15,000 multiplied by 28%. So 2.8, which we deduct, and 4.2, which we add. Nice one, it's 4200. Right, to complete your reconciling items, you then bring down this value. So you then say, right, a recognition of unused, right, tax losses previously not recognized. So then you bring the 137,200 down. If it's a negative here, it becomes a negative there. When you close that calculation, you should get 98,000 or 9.800. Right, and you'll be done with that reconciliation. And that will be the end of that particular question. Any questions from the floor? Right, I'll complement this video with some short examples so that at least we can augment the work that we have done here. But you have got a lot of work. If someone at CTA level or at 3761 is saying text is difficult, they will be talking about this. If you understand this, then you can answer most questions on income tax in any test by exam. So we need to be very, very, very clear on that. Right. Any questions from the floor? Right. If there is no question from the floor, right, then we'll end our session here.